value trades, Forex, CFDs, and commodities.
Good evening, traders. I'm happy to be back here with Elliott Trades today. And we have an exciting topic today: how to trade Forex using the Elliott Wave Theory. This topic follows my last webinar about swing trading, because in swing trading and in the method of Elliott Waves, we try to identify and trade swings in markets. Elliott Waves is a very complex subject, so we have to deal with a lot of theory today. I try to limit it to what was necessary. In particular, I will not go into the correction patterns and the exceptions of the Elliott Wave Theory. I have to apologize for last time. I exceeded my speaking time. As a result, another webinar had to start later. So please excuse if some of the points may be missed out today, but we have to get through with it within that 1 hour of time we have here with that webinar. If the topic has accused your interest, let us know about it and we can schedule another in-deep webinar on that topic. If you have questions, I would ask you to ask them at the end. Experience has shown that many of the questions arise during the course of the webinar. So we can do a Q&A session at the end of the webinar. However, before we begin, I would ask you to take a look at the risk disclaimer. Especially as a speaker, I do not assume any liability for the presented ideas. These are for training purpose only. If you act according to my setup, you do so at your own risk. Our topic today is how we can use Elliott Wave Theory for our Forex trading. So I forgot to put in the slide where I do introduce myself. My name is Daniel Schütz. I'm a professional trader from Germany. I'm an author of several trading books, and I'm the chief editor of the Portfolio Journal. That's a German magazine we put out to 12,000 people each month on the topic of investing money. So because I forgot that, we just can jump into the topic of trading Forex by using the Elliott Wave Theory. This webinar should not be about learning the perfect wave count. Only the basic terms are explained in that webinar. And so if you want to know more about that, if you want to have a deep dive, please let us know, and we can set up a second webinar with the special topic on that. Elliott, Ralph Nelson Elliott, lived from 1871 to 1948, and he was an accountant by profession, but that was not all. He also was a gifted guy who was interested in math, and so he tried to find a way how predict market movements in the financial markets. And you have to go back to around 1930. Psychology was not very common at that time, and people assumed that market movements were unpredictable. And so what Elliott did, it was a brand new thing. Elliott himself, he saw his theory as a necessary complement to the Dow theory. And we discussed these in detail in my last webinar. So if you're not familiar with the Dow theory, please take a look at the recording of that webinar. Elliott published his wave principle idea in 1938, after which it was forgotten for some time until it was taken up again in, I think it was around 1970, 1980 by Robert Brechter and H.A. Forst. And before we start with the Elliott Wave Theory, there's one thing that occurs a lot of problems with traders. They try to get into the topic, and that's the fractal nature of the waves. And this issue causes a lot of problems for newcomers in the Elliott Wave Theory in trading. Therefore, I will spend a lot of time at the beginning of the webinar to clarify this principle. But before we start, we have to talk about psychology. This is an important key to the Elliott theory because, like any other pattern trading, the Elliott waves are based on the psychology of the masses. And so when it comes to pattern, whether it is a triangle, a flag, or whatever, or a head and shoulder formation or something else, pattern trading is always about psychology, the psychology of the market participants. And it is exactly the same with the Elliott waves. Trading with Elliott waves is about recognizing patterns that repeat themselves. The market moves 3 steps forward and then 2 steps back. This is a result of the sequence pulse, correction, and that is what Elliott figured out at that time. And before we get into the waves and all that, let's go back to what we discussed in my last webinar on swing trading, because swing trading and Elliott waves have a lot in common. What sets market movements in motion is usually a reaction of news events. And even before this event, traders has positioned differently in the market. And so let's take a look at the different trader types we have. Between the green lines here, you see the market is moving sidewards. And all traders see that current moving sidewards of the markets. And this is the area between the green bars where we have traders. They are already long because they wait or they can wait the markets breaking out of that range, and they want to be the first in the market and already open position. Then we have the short ones. They don't believe the market coming up, and they also can't wait until the market breaks out of these green lines. And so they already open the short position. And then we have the undecided traders. They wait, they stand behind the line, and they say, okay, let's take a look where the market will break out of this range. And so the first who can wait, they are already positioned, and then the market breaks out. All the 3 group of traders have an interest in the market coming back from the point above. That's here. So the long traders, they hope for reset for purchase. So they see they already on the right side of the market, and they hope the market comes back so they can get in cheap with another position. With the short traders, they hope that the market will come back so they can get out of that position on a good price. And with the undecided, they hope the market will come back so they know now the market will move up, and they'd like to open a position on that point here. So all kind of traders have an interest, the market will come back. And so often it happens that the market really come back because the first traders, the day traders, they close their long positions at the point above here to realize the first profit targets. And so there's some pressure coming into the market, coming back to that structure level here, and then the long traders who are already long and want to open the second position come into the market. The short traders, they close their position here at that point. And the undecided traders, they see now the opportunities there that they can open another position. And so pressure comes into the market and the market goes up. That's basically what's behind market movements. So we have a lot of psychology in there involved. We have traders, they can't wait. They want to jump in early into the markets. Then they hope the market come back, for example, to open the second position or to close the position at a good price. And we have the undecided. They want to wait until the breakout happens, and then they want to open a position. So that's the psychology behind market movements. And so we have two market phases. With impulse phases, or in Elliott Wave, we call it impulse waves. They are powerful. They move the markets forward. Most of the time, they are smooth and clean. That means we have nice candles, for example, in an up movement, we have nice green or white candles. They go up and show a clear direction. These are the movements we should be looking for as a trader. Particularly when I'm a beginner in trading, I should focus on impulse waves. Let's take a look at the market. Impulse waves are powerful. I already told you they move the market forwards. But what happens? Here in that example, the market comes from above, and we have a short here, and then most of the time a news event comes up and the market starts to rise again. And the first one here, that is, we call it a wave one. That's an impulse wave. You see it, it goes up. We have correction, we have another impulse wave, that's wave three, we have correction, and then we have another impulse. Wave one, wave two, wave three, wave four, and wave five. So within that one trend or within that movement, we have different directions. We have directions going up and we have directions going down. So we have a long, we have a short, we have a long, we have a short, we have a long. We have an impulse, we have correction, we have an impulse, we have correction, and we have an impulse. So the primary trend is up at that moment. That's what I told you. Markets move 3 steps forward and then 2 steps backward. This is a result in the sequence of pulse, correction, pulse, correction. When it comes to pattern trading, I told you that it doesn't matter if it's a triangle, if it's a head and shoulder, or whatever formation. It comes down to the psychology of the markets, and that's what I was trying to show you with the first picture, with the undecided traders, with the traders they are already long, with the traders they short, and so they move the markets. And the second phase we have, I already told you, it's the corrective. And in Elliott Wave, it is that we denote the impulse wave as or by numbers, and the corrective waves by letters. And this looks like that. We have the corrective on the red, that's a corrective wave. And that's A, B, C. So we have here the wave A, the wave B, and the wave C. So if you see a chart and there is a wave 1, then you know that you are in an impulse wave. And if you read about a wave A, because it's denoted by letters, then you know you're in a corrective wave. This very simple, or what we see here is a very simple Elliott wave pattern. We have 5 waves up and 3 waves down. And now the a little bit more complicated fact of Elliott waves comes up. That's the fractal. Elliott wave is a fractal. That means that each individual wave contains 3 own sets of waves. So in this particular vanilla plane situation, we have wave 1 that will contain 5 smaller degree waves, and wave 2 that contains 3 smaller degree waves. That is what's going on with the fractal. Wave 3 will contain smaller waves, also wave 4 and so on. That's one of the most important things you have to understand. Impulse waves, these are the waves 1, 3, and 5. And the waves A and C. Usually they have 5 waves. Our correction waves have 3 waves. These are the waves 2, 4, and the wave B. That sounds a little bit confusing. Now I try to visualize it. We have the wave 1. And as an impulse wave, wave 1 contains 5 smaller waves. So that's the gray one here. The second impulse wave is wave 3. It has also 5 minor waves. And also the wave 5 is an impulse wave. And to make it absolutely confusing, the wave A and the wave C are also impulse waves. So the important thing to understand is that the impulse waves 1, 3, and 5, as well as the waves A and C, contain all 5 waves. All correctional waves usually contain 3 waves. In this explanation, these are the waves 2, 4, and the wave B. All correction waves have 3 waves. So this wave 2, this wave 4, and this is wave B. So if we count Elliott waves, we always count the wave at the end of the wave. So wave 1 begins down here and goes to that height over here. So the number, the 1 for wave 1, sits at the end of the wave. So wave 2, the correction, goes down to that low, and the number is at the low of the wave. And same thing on wave 3, it's on the top of wave 3. Altogether, it looks like that. We have the impulse waves that contains 5 waves, and with the correction waves, those are 3 waves. And so we have a complete circle, and that is the fractional. And fractional thing means that also this gray wave here contains of 5 up, 3 down, 5 up, 3 down, and 5 up. So from big picture to the smaller picture to a very small picture, all that, the fractional nature of the markets means that the impulse waves have 5 waves and the correction waves have 3 waves. Yeah, it depends on the time frame used in the chart settings. So often you don't see the subordinated waves anymore. This happens, for example, quite often if you have selected the setting of an end of day chart. So if one candle represents the price action of a whole day, then maybe you're not able to see the 5 up and the 3 down. The difference can then often no longer be identified at the first glance. So you have no clue if it's really 5 up or 3 down. Often these nuances only come to light on an intraday chart. What many people do with an end of day chart is to break it down in an intraday chart and identify the smaller degree patterns there. So if you're on a daily chart, if you're on a daily basis, then a lot of people use a 4-hour chart, for example, in Forex. It's very common to use that 4-hour chart or 1-hour chart, and they try to identify the 5 up and the 3 down in that smaller time frame. So I try to visualize it in one chart to make that all clear what fractional really means. So we have an up movement and we have correction. So we have an impulse and we have corrective wave here up there. If you're at a higher time frame, for example, if a daily chart, it looks like that, and you can figure out if we really have a 5 up and a 3 down or whatever. So a lot of people, they try to scale down on a 4-hour and 1-hour chart, and looks like that. Then you can see the wave up. That's an impulse wave, wave 1. Wave 2, that's a corrective wave. Wave 3, that's an impulse wave again. Wave 4 as a correction wave, and the wave 5. That's the impulse. And on that impulse, there follows the correction. That's a correction wave A. Correction wave A as an impulse. Then the correction of the correction, that's the wave B. And then wave C as another impulse wave. And if we scale down to a lower time frame again, then it will look like that. The wave 1 we also can count as a 5 up, wave 2 as a 3 down, wave 3 as a 5 up, wave 4 as a 3 down. So this means the fractal nature of Elliott waves. So even if we break down the wave 1 more, then we see on that wave 1 another 5 up, 3 down, 5 up, 3 down. And that is what makes Elliott wave for newbies really complicated, because they never know where the hell I'm at the moment. Am I at wave 1, at wave 3, or what is it? But that's not the important fact. The important fact is to figure out, are you in an impulse wave or are you in a correction or corrective wave? And we try to do that later on. I show you my setup, how I use that. And to make it much more complicated, we have the wave decrease. I'm terrible sorry, but something going wrong with the character set. Here the slide looked a bit unattractive. But however, if you read and analyze it, it seems a little strange to you when counting the Elliott waves, and you see other numbers or letters than those we just have discussed, because they describe the different trend levels or the wave decrease in more detail. So it can happen that there is no 1, 2, 3, 4, 5, but we have we have other counting systems here, and the other counting systems here mean we have different wave decrease. If we take a look at a long-term chart, for example, if we go back to the late 1800s in the Dow Jones, and we take a look at the wave count in there, then maybe we take a look at the grand super circle, and then it's the Roman 1 in a circle, or it's a super circle, a 1 in the brackets here. That's 5 with a trend, and the 3 is against the trend. Then we have the small a in a circle, or we have the a in the brackets. That means we have different wave decrease, and those different wave decrease, they represent a different time period. From the large, I already told you, super circle that can last for several years or decades, to a nano circle that can also occur one smallest time level. So we have that down here. It can be a minute chart, a 60-minute chart, or whatever. So we have from decades to minutes, everything represented here. And if we have the 1, 2, 3, 4, 5 and the ABC as I show you, we actually in a minor wave decrease. That means we're looking at the time period, monthly, weekly, daily, or 250 minute chart. That's what we use there. So the way the chart is labeled is not uniform at each chart or each analysis you see there. Therefore, always ask the author of the analysis which character set he uses. But most of the analysis you see on a daily basis, they use the minor wave degree here, and they use the 1, 2, 3, 4, 5, and the ABC, monthly, weekly, daily, or 250-minute chart. But if you see other characters here, take a look if you're at a long-term chart, maybe super circle or whatever. So it is often the case that the different options at Elliott waves are given. This is because the counting of the waves distinguish between rules and guidelines. So we can have several analyses made with the Elliott theory, and they come to different results. And that is because the rules are set, the rules are black or white, that's for sure, and rules can be broken. But in the case of the guidelines, there's a problem. The guidelines and how they are used depend very much on the analyst. And that is one fact that makes Elliott waves complicated. Because we have a set of rules that cannot be broken, and then we have the guidelines the analyst has to interpret how he uses that. So let's go to the hard facts that are the rules, and there are only 3 of it I use in my trading, and that's rule number 1. Rule number 1 is quite simple. Rule number 1 says wave 2 cannot retrace 100% of wave 1. What does that mean? So here we have wave 1 and we have wave 2. Wave 2 cannot retrace 100% of wave 1. So if we count wave 1 and we count wave 2, and wave 2 goes below the low of the starting point of wave 1, then we know this is not a veiled Elliott wave count. Quite simple as that. That's rule number 1. Wave 2 cannot retrace 100% of wave 1. That is a very important rule because I can use this rule to set my stop in trading, because if I use this rule, rule number 1, for the stop setting in my trading, I can set my stop close below the low of the starting point of wave 1, because I know if the market breaks through that level, the counting of that Elliott wave was wrong. Then this was not a wave 1, and we're not in an impulse wave. Maybe we're in a corrective wave then. And so this rule helps us very much in money management, in trading setup, and in finding our trading idea with Elliott waves. Let's go to rule number 2. Rule number 2 says wave 3 cannot be the shortest wave. So this is wave 1, impulse wave, wave 2, correction wave, and wave 3. Wave 3 cannot be the shortest wave. So if a chart looks like that, it's no veiled Elliott wave count. Wave 3 is usually the longest wave, but it decently never can be the shortest. So if you see a picture like that, you know it is not a veiled Elliott wave count. Wave 3 cannot be the shortest wave. And then we come to rule number 3. Wave 4 cannot overlap wave 1. So we have the impulse wave 1, the correction wave 2, the impulse wave 3, and the correction wave 4. And wave number 4 cannot overlap with wave number 1. So if we see a picture like that, that wave 4 is going below the high of wave number 1, then we do know we have no veiled Elliott wave count. And so we can figure out if we are really in an impulse wave or if we are in a correction. Correction wave can look nasty. And this is one point how we can figure out if we are in a correction or in an impulse wave. Those 3 simple rules can help us to improve our trading with Elliott Waves. And then I already said we come to the guidelines, and that's what makes Elliott Wave complicated. The guidelines and the exceptions. I told you I'm not going to speak about exceptions today. I'm not going to talk with you about the correction waves or correction wave patterns we can have. That's complicated. That's what makes trading with Elliott Waves complicated. I show you an easy way how to use Elliott Waves for your Forex trading to make money with that. But first of all, we have to take a look at the guidelines. My tip is to keep the guidelines in mind, but keep your trading simple. Seldom it is the case that when trading is made or is made very complicated, this then also brings a multiple of success. So keep it simple. Especially as a beginner in trading, I should be careful to choose the setups that promise the greatest success. It is easier to earn money in a smooth and strong market than in one that jumps up and back and forth and back, and where the chart already looks ugly. Remember, if it looks ugly, it is often a correction, because trading impulse waves means trading smooth and strong movements. These are the waves 1, 3, and 5. Do not trade the corrective waves, the 2 and the 4. Those are choppy and messy. The candles are small, they often overlap. We have frequent change of black and white or red and green, whatever your candle color is. And there you can see you're in a correction. And remember, if it smells funny, I don't eat it. So concentrate on the impulse waves. Another guideline, wave 2 tends to retrace between 50 and 70% of wave 1. What does that mean? We have wave 1 and we take the Fibonacci measurements, and Elliott Wave works great with Fibonacci. So we measure the distance of the wave 1 and we look how deep the retracement is. So we measure from the down of wave 1 to the high of wave 1, and we try to figure out where the turning point of wave 2 is. Is it a 50% or is it the 61.8 Fibonacci retracement of wave 1? So it should be something between 50 and 70%, and 61.8, it's the Fibonacci number we are looking for. That's one of the guidelines. Another guideline is wave 4 is a little shallower. Wave 4 tends to retrace between 30 and 50% of wave 3. So we measure wave 3. From the beginning of wave 3 to the high of wave 3, we measure, and we want to see 30 or 50% Fibonacci retracement of wave 3. And we all know the Fibonacci number we are looking for is the 38.2% retracement, or the 50% retracement at that point. That's one of the guidelines. Another guideline is wave 1 and wave 5 tend to be the same length. Not at all time, not perfectly, not at all time. Don't forget, it's no science. But they say typically they are the same size. That's what they say. Personally, however, I do not trade the wave 5. As it happens often that the wave 5 fails. So the wave 5 doesn't come up to the high over here. It can be a complex wave, the wave number 5. So all I do in my trading personally, that's my personal opinion, I concentrate on the wave 3. Because I think it's too choppy and too risky to trade wave number 5, and to trade wave number 1. I have no clue if it really is a wave number 1. I need wave number 2 to get security on my decision, or to be safe on what I'm thinking. So wave 1 I can trade. Wave 5 it's too choppy or too risky for me to trade that. And so the only impulse wave I can concentrate on is wave number 3. And that's the same as I told you in the last webinar. I tried to cut out a piece of wave 3. Don't forget, it's just like the last time we talked about swing trading. It's a trend following system. If we want to trade Elliott waves and trade the impulse waves, then we are trend follower. And so if we can cut out a piece of that wave number 3, that's the goal we should go for. A corrective wave and a corrective wave A and a corrective wave C tend to be the same length. That's one of the another guidelines we have here. And however, I personally do not trade corrections very, very often. Even for beginners, I would not recommend to do so. You should only trade corrections if you have the necessary experience to do so. As I said earlier, we often recognize correction by the fact that they are overlap the candles, and we have a great range of variety correction patterns. So that's why I very much prefer the impulse waves in the trend direction instead of trading the arcly correction patterns. You need to develop a sense of what looks good and what doesn't. Are the proportions right? For this, there's the aid of the Fibonacci's. If you try to figure out if we have a good wave 3 or a good wave 4 or a good wave 2, then you can use the Fibonacci's to measure those movements. And you should trade what hits you right between your eyes. If it doesn't appeal, don't touch it. So if it smells funny, if you have the small candles, if you have no smooth chart, if you have no clear chart, if you have the overlapping candles, if you have the undecided of the markets, if you see that, if you feel the market is undecided, then don't eat it, then don't touch it. As always, when trading patterns, they have to be right at price and time. They're supposed to be nice, smooth waves we're looking for. The rules must be followed. That's very important. And the patterns should correspond to the guidelines we just were talking about. Develop a feeling for it. That's one of the key points. And yeah, there's one law of alternation that sounds very sophisticated, but it is quite easy. The law of alternation is important. It's very important for trading Elliott waves, but luckily it's very simple. To explain it, however, I have to make some adjustments. So far, we have discussed that the corrections, the wave 2 and the wave 4, are always an A, B, C pattern. However, I said it before, corrections can be very complex. And they can look really ugly and they can drive you crazy. That is also the reason why I do not recommend corrections for beginners in trading. And so the law of alternation now says following: if we have two simple patterns, then wave 4 must be the opposite, a complex pattern. So if wave 2 is a simple pattern, this wave here, if it's a simple down, up, down pattern, then the wave 4 has to be a complex pattern. Looks like that. Wave 2, it's a simple pattern, down, up, down, simple. And wave 4 looks a little bit more choppy then. That's the rule of alternation. If wave 2 is a complex pattern, then wave 4 has to be a simple down, up, down. That's the rule of alternation. But the rule of alternation also says if wave 2 comes steep, so 62% retracement, then the wave number 4 has to be shallow, so 38 retracement. But the other way down, if we have a 38 at wave 2, then the wave 4 has to be deep. Rule of alternation. Another thing is law of alternation. If we have wave number 2 as a sharp correction wave, then the wave 4 has to be a flat correction wave. And the opposite, if wave 2 is very flat, then we can expect a very sharp correction wave at wave number 4. That's the law or the rule of alternation. So now, why I don't recommend corrections to trade, especially for newbies in trading. There are 12 standard correction patterns and 10 special shapes for the correction. So at all, we have 22 different kind of correction waves or correction patterns we can have. And corrections can be ugly, and therefore, as a beginner, I recommend once again to keep your hands off the corrections. But the topic today is not to learn the perfect wave count, but how I can use Elliott Wave principle for my own trading. Because the best analysis is no use if I can't convert it into a trade afterwards. It does me no good to be able to explain correction patterns exactly at the end of the day, because then the markets would have run on long ago. And so I decided not to talk to you about the correction patterns today, but to show you how I use Elliott Waves for my own trading setup. And that's what we're going to do now. I show you my trading setup, and again, that's the plain vanilla circle of an Elliott wave, as we want to have with the wave 1, with the wave 2, what is often 61.8% of wave 1. Then we have the wave 3, that is often a 161.8 of wave 1. So from the low of wave 1 to the high of wave 1 down to the wave 2, we have 161.8. And that's one of the targets we can use for trading the wave 3, and I already marked the wave 3 in red. So that's what I'm going to concentrate on when I trade on the Elliott wave setup. And then with the wave 4, that's usually 38.2% retracement of wave 3. Then we have the wave 4. I already told you wave 5 can fail, so I do not trade these wave 5. I know a lot of people do so, but I would not recommend to do that as a newbie in trading. And then we go after reaching the wave 5, the high of wave 5. We get into the correction. We have the wave A, the wave B, and the wave C. And my goal is to get a piece out of that red wave 3. And my setup is very, very simple. So I identify a downtrend, and for my long setup, I wait until this trend is broken. So I'm looking for a trend break. What we have here, we can paint in a trend line, and if this trend line is broken, I'm on high alert to look for my trading setup. I wait for the first wave until the first wave is over, and I look if I can count it to 5. So I'm looking for the 5 waves in there. 1, 2, 3, 4, 5. Then if this happens, I wait for the wave 2 and see if I can count wave 3 to an A, B, C. That would be wave 2. If the wave 3 goes to the retracement of 50% or 61.8% of the wave 1, and I will find a turning point, or the market will find a turning point here, then I look for my entrance. So I have a lot of time. I identify the downtrend. I identify the break of the downtrend. I identify wave number one in counting 5 waves, up, correction, up, correction, up. Then I wait until the correction is done, basically at a 61.8 retracement of wave one, and then I look for my entry, and there are several points of entry I can use, as exactly 3. For example, I can use I can use a reversal candle at that point. If I see the retracement of 38.250 or 61.8, I can use it to identify a reversal candle at that point. If I see that reversal candle, I can wait another candle and get into the market after that. That's the first entry. Second entry would be after exceeding 61.8 retracement of wave 2. So I measure wave 2, and after going over the 61.8 retracement, I get into the markets. Or entry 3 would be after exceeding the high of wave 1. That point here, I will get into the market. And then we have the wave 3, and I can write the wave 3, and I can measure my target. My target would be 161.8% of the retracement from the down of wave 1 to the high of wave 1 down to the low of wave 2, the 161.8 retracement as a target. And there we have the entries. The entry 1 would be the reversal candle at the, I would prefer the 61.8 retracement. Entry 2 would be a candle close over the retracement of wave 2, and entry 3 would be the high over wave 1, the new high over wave 1. The stop, as I already told you at the beginning of that webinar, could be down here below the low of wave 2, or if you want to give the market a little bit more space to move, then you can set your stop level below the low of wave 1, because we know that's one of the rules of Elliott Waves. If the market goes below the low of wave 1, then the count is no longer valid. And so we have everything we need. We have entry 1, entry 2, entry 3, whatever your risk appetite tells you you can get into the market. You have your target, you have your stop, and you have complete setup how you can trade with Elliott Waves. Here's the setup again. Identify the downtrend. Look for break of the trend. Wait the first wave and see if I can count it to 5. So wave 1 to 4 to 5, 3 up, 2 downs, and then I wait for the wave 2 and see if I can count it to 3. I want to have the wave A, the wave B, and the wave C. If the wave 3 comes, or if the wave 3 shows the retracement of 50 or 61.8 Fibonacci retracement of the wave 1, and find a turning point there, then I'll look for my entry, and that entry could be a reversal candle. A reversal candle at the 61.8, or it could be exceeding of 61.8 retracement of wave 2, or after exceeding the high of the wave 1, we can get into the market with a new high. The stop is below wave 2, or if you want to give the market a little more space to move, it is below the low of wave 1, and the profit target is 161.8% Fibonacci from wave 1, and we measure the low of wave 1 to the high of wave 1 and go back to wave 2. That's how we measure that target of the Elliott Wave setup here. And the short is absolutely the same. We have an uptrend, we wait until the trend is broken, then we want to count a 5 down and an A, B, C up. We hope that that turns at a 38.250 or 61.8 retracement of wave 1, and then we try to find our entry here. The target also would be the 161.8% down. We are measuring from the high of wave 1 to the low of wave 1 up to the high of wave 2. And then we can find our entry. Our entry 1 would be here a reversal candle, or it would be a breakthrough the 61.8 retracement of wave 2, or it would be a lower low than wave 1 was showing to us. The stop would be above the turning point of wave 2, or if you want to give the market a little bit more space, then it would be above the high of wave 1. And that's it. Definitely keep it simple. The perfect wave count does not bring you money. Elliott Wave is not making money. Money comes from creating a positive expectation or your entry or your stop strategy, your money management, and your psychology. That's very important. And that is how you make money trading the markets. The money is not made because it is a perfect Elliott Wave pattern. Concentrate on the core rules. There are only 3 rules, and keep the other things in mind, but concentrate on the core rules. And if there are any questions, please feel free to ask them. So it seems to be no questions here, so I can say thank you for your interest in Elliott Wave trading the Forex markets with Elliott Waves, and thank you to Value Trades for having me here today. And if you're interested in another webinar, in a deep dive webinar on Elliott Waves, please let Value Trades know. And I wish you good evening to all, and until next time, thank you very much.